like Alan said, I'm Burke Adams. I've been with Western AgCredit now for just over 2 years, work out of the Cedar City office, and really enjoy working with Farm Credit, working with great customers. I grew up on a farm, working on a farm in Parowan, Utah. Everybody knows where that is. We grew alfalfa and had a herd of cows. And so today I'm going to be going over the basics, kind of the overview of what you're going to be hearing today, called the 5 C's of credit. These are kind of the foundational things that we go over, all the criteria that you meet as you go to apply for a loan. We look at these 5 C's of credit and analyze your loan. Okay, so like mentioned, Western AgCredit and every other lending institution has some form of 5 C's of credit. They might use a different thing, but generally everybody uses some sort of type of this evaluation when we're evaluating requests for money. And so each C represents a different component in the decision process when you're analyzing your loan request. So what are those 5 C's? First, there's character, capacity, capital, conditions, collateral, and that's the 5 right there. Anybody, when you look at those 5 things, does any one of those pop out to you maybe the most important? I think you're right. And they're all important. Of course, the answer is they're all important, but character, which is the first one I'm going to be talking about, that has to be there. I think everybody kind of understands why. So every lending decision requires an answer to that basic question, and this is kind of the basis of can we lend to this person? Is the customer of a sound character, and do they have the management ability to run the operation and repay the loan? And your character plays into that, obviously. And so, and just like you mentioned in the back, character has been regarded as the most important because that's the catalyst that transforms into everything else. Transforms your expectations, goals, and projections into realities. And so, as we talk about here more, so as a lender, as we're looking at your loan request, we also take into account your character, your reputation. If you've built a good reputation among your neighbors, of your people you're buying from, people talk, and so we know that when you come and talk to us, you've got a sound character. And when we interview you through ask you some questions through the lending process, we can kind of get an idea about your character. And that is a very important factor because it does play out. When you look at your farming operation, is it successful? Your character plays into that, and you can see that. It's not just something that we pull from an interview. So, as in other credit factors, the importance of character needs to be balanced against the level of risk to the organization. So even though you may have a good character, that isn't everything, but it is definitely one of the most important. All right. Okay, so what is character? It is right here. It's defined as the customer's willingness and determination to repay the loan regardless of unforeseen adversity. So what are some unforeseen adversities in agriculture? That never happens, right? Name a couple.
Natural disasters, fire, earthquake,
Obama.
sinkhole opening up and swallowing
Obama. Yes. All good. Price changes. Are there any cow-calf operations in here, beef cattle? We've seen the prices drop drastically. Alfalfa. We'll be talking a little bit more. I'll give an example of that here shortly. Last year, we saw prices as high as $260 a ton. We're in the South. For dairy hay and dropped almost $100. So when those things happen, is your character going to come through? Are you going to be able to withstand those unforeseen adversities? Are you going to have that character to repay the loan even when times get tough? And so that's another reason I enjoy working in agriculture is everybody seems to have a good sound character in agriculture. If they don't, they usually can't make it through it, so for the most part. All right. So we all know this character includes such qualities: honesty, openness. That's another thing that is a strong character trait, is openness. Be honest with the lender. It doesn't do you any good to hold back any information. It usually will come out in the wash. If you've had a bad year, if you've struggling with something on the farm, go ahead and present that to the lender and work through that. But openness is definitely a big thing. Integrity, obviously. Self-discipline, again, when you go through those high years and make really good profits, are you able to have that self-discipline to hold some of that back for those down years? So, again, in general, it should be, it is a necessity, but shouldn't just be held as the only condition that we look at for performance on a loan. Okay, here's a little quote for you to kind of sum up the character section of this. So people with good intentions make promises, but people with good character keep them. And so that's what we're looking at, is for people with good character who can come in and we know that you're going to keep the promises that you're going to make, that you're going to buy a farm. We know that you have that integrity and that character to make it through, and you're going to weather that. And in agriculture, that's something you've obviously got to do, is work through those hard times, because they are going to come, and I'm sure everybody in here has experienced that. So the next thing is capacity. Capacity refers to the customer's ability to generate sufficient earnings and repay their obligations. So, what are some of these obligations? So you've got current obligations. When you come to look at a loan, a lot of people have a house payment. Maybe if you've got car payments, you've still got to take care of those obligations. Your family living expenses, new debt that you're looking for. Plus you've got to have capital replacement, replacing your equipment or your cattle or whatever operation you're in. You've got to have that. And also accumulation for adversity. And so a lot of times we get a phone call. This is generally what happens when we get new borrowers or potential borrowers who have never had a loan before. They'll call up and they'll say, hey, I've got a farm, 500 acres, let's just say it's for sale for $1 million, and I want to get a loan. Well, one of the first things we have to say is, we've got to have 30% down on the loan, roughly 30%. What's your experience in farming? Can you repay the loan? What's your repayment on that? I think a lot of people, we get in our minds that we can come in, offer up some collateral, and the bank will immediately give you the loan because you meet that loan to value. I've got a down payment. What you've got to take into consideration too is your down payment. You might have that, but is that going to take away your cash for your operating expenses? Then are you going to have to go back and borrow more to run the farm? Once you get the farm, is the equipment adequate? Do you have that repayment capacity? Is the farm going to generate enough income to cover all of those expenses? And so definitely another important part of the 5 C's is capacity here. So I just want to touch briefly on this. I think this might get touched on a little bit later on in some of the presentations, and this is some of those, this is where my wife got frustrated with me because I was talking about some things she didn't understand. But I'm just going to read through this, and if you've got any questions, we can touch a bit. Earnings capacity is not the same as cash flow. So accrual adjustments must be made to cash income records to accurately determine net income or earned net worth change. An operation can have sufficient cash flow to meet current obligations without having positive net earnings. The reverse can also be true. So we're talking about accrual adjustments. That's in taxes or in accounting. The difference between cash and accrual, when you go off cash accounting, that means when you get paid for something, you account for it on your books right then. On accrual accounting, let's say you've sold your hay but you haven't been paid for it, you account for it then. So basically accrual accounting takes it back to the time or to the year that you sold that product. So a lot of people, for tax reasons, they'll hold a check and not cash it for the next year just to save on taxes. So for accrual adjustments, we'll move that back into the previous year, if that makes sense. I don't want to go into too much detail on that to confuse you, but that's one of the things that we look at there. So the other thing is the first use of net income is to cover withdrawals for family living. The remainder is then used to repay capital debts or buy new assets, and income not necessary for these purposes is available to expand, invest, or build a reserve. And so we're going to look at all of your, we pull a credit report. We look at all of your obligations. That shows like your house payments, your car payments. We estimate your family living expenses. Do you have a big house? Do you have a big family? What kind of cars do you drive? Are you living a very expensive lifestyle? We have to take that into account. Because a lot of times people can underestimate their family living expense. But then after that family living expense, how much can you allocate to debt? And then after all of that debt, are you going to have money left over then to expand, invest, and build a reserve? All very important things. Okay, when analyzing the repayment capacity, we examine both the historical and projected cash flows and income statements or earned net worth changes. And so when you come in, generally we ask for some balance sheets and 3 to 5 years of tax returns. We want to analyze the historical and compare it to the day. Does anybody understand why we do that? Why don't we just take a year, how you're looking today? Why do you think we get that historical? Why do we want to get a historical picture of your operation?
Gives you an idea of the highs and lows we've gone through.
Right. Exactly. And so a good point, case in point again, these last couple years in southern Utah, we deal mainly with alfalfa and cow-calf operations. Both have been through the roof these last couple of years. And so when we look at somebody coming in, let's say they want to come in for a cattle loan, and they've gone through these last 2 years and it looks very lean, that their balance sheet, they're just barely squeaking by. That's going to be a concern. Yeah, they look good right now, but those years where they should have been really building, they've just barely gotten by. And so now when the price drops off, that's how the bank has to look at it. So here's another good example that, and maybe it'll help you understand how a bank looks at your loan. So the price of hay, again, let's say it was $250 a ton last year. When we're doing your projections, we don't actually project your income at $250 a ton. We do a long-term price, say closer to around $160 a ton. So if we can analyze your operation and you can cash flow at $160 a ton, then you're going to be able to make it through those lean years. And so the bank, we have to analyze it looking at it that way. It might be frustrating to some people, say, hey, the price is through the roof. I mean, I'm making a killing right now. But if your break even, let's say your break even on hay is 170 and you're making 260, everything looks golden, but now the price has dropped. Now you're $10 below your break even point, and the loan isn't going to work. And so that's, from a lender's standpoint, we have to look at things on a long-term process. And so hopefully that makes sense. So that's why we want to analyze your historical too. How have you done in the good years? How have you done in the bad years? We expect to see some drops in there on those bad years, but how far were they? and how much did they affect the operation. So, whoop. Okay, and we talked about this earlier. Over the longer term, the repayment capacity needs to be sufficient to cover those occasional operating losses. We obviously take into account that that's going to happen. We don't expect every year you're going to be making a climb like this. Everybody knows farming goes like this. And agriculture prices change. And so, but what's your overall health of your operation? That's what we want to get a good picture of when looking at capacity. Okay, and it's closely related to the next thing we're going to be talking about, which is capital. Okay, so as the risk of low or negative capacity margin increases, a correspondingly stronger capital position is required to ensure that sufficient repayment reserves are available and should there be an earnings shortfall. So what that means is your capacity to repay is going down. We want to see your capital rising to offset those factors. That even though maybe your cash flow is dropping, is your net worth rising? Is there offsetting factors to go along with that? Now here's an example of some risk that goes into the capacity. So again, I like to use the hay example. Let's say you've got 500 acres and you're raising 5 tons to the acre, which is about average. Hay prices are $260 a ton. At 5 tons per acre on 500 acres, that's $650,000. And the price drops to $160, your income drops to $400,000. That's a $250,000 difference. And so when you are getting ready, I was going to ask this question before. Let me back up here. How many in here are potential farmers or potential loan getters, I guess? I don't know. Right back here. Or how many people have loans right now on the books, I guess? Is there a lot of you here that... Okay. I guess I just wanted to, I guess for planning purposes, for those who are looking for a loan, that's something you want to analyze and look as don't do your projections on the high prices. Project your income and your expenses on those lean years. So then you have some realistic expectations when you're going in to a lender. And then when you have the good years, you're in much better situation, and then you're not banking on those high prices. And so when you're doing those projections and you're getting ready to do a loan, do your projections off the lean years, and that will help you a lot. Okay, so our next C is capital. And this refers to the customer's financial position and is typically reflected on the individual's or entity's balance sheet. An evaluation of the capital position usually involves the analysis of your financial progress. Just like we said before, we're looking at your progress over the years. We get a history of your operation, and we see your financial strength over those years and check your net worth. We're also looking at your financial progress, the asset quality, working capital, liquidity, solvency, and debt structure. So have you been paying your debts down? Are you steeping up a lot of debt? Are you getting yourself into some trouble? We've got to look at that. Your asset quality, what's your equipment look like? Is everything old and depreciated out? Is it functional? Are you always having to repair it? Are you maintaining equipment that might be a little bit older but is very functional? You maintain it well? Or is everything brand new? Are you leveraging yourself? Are you buying all the brand new equipment and getting yourself overextended? We want to look at the asset quality. Working capital, we'll touch on these a little bit more just briefly because I know those are going to be covered a little bit more in some other presentations. So the analysis of these factors, again, involves historical and current balance sheets together with some income statements, that's like your taxes or profit and loss, of even dates so that cash to accrual and changes in net worth can be evaluated. So why do you think it's important that we get balance sheets on even dates? Does that make sense? you're my go-to guy right here. Maybe anybody else can talk too, so that just don't be shy. Go ahead.
Just more information. The detailed information gives you evaluated opinion of what you need to do.
Mm-hmm. Right. And the reason we want them on the same dates, so let's say you usually have a same time of the year that you sell your commodity. Let's use cows for example. Generally, let's say they're sold in October, and we get your balance sheets in September every year, and then we get one in November. So the reason we want even dates is on September we show all those cows on the balance sheet, and every year after that we get that same snapshot on that same month, so we can kind of see the same progress. How many calves do they have this year? Have they had the same progress? Are they getting less calves? Is their death loss higher? How many are they holding back? But if we get that balance sheet in November and the cows are sold, then it's harder to back into that. Does that make sense? And so that's why we like to get those even dates. If we can get the balance sheets at the same time each year. Tax returns are usually easier because they're at the end of the year, but balance sheets, we like to get those at an even date so we can analyze and make a clear picture of that operation. Whereas when we get those uneven dates, it's hard to see where the operation is, because once you sell the calves, they might have already gone out and bought some fertilizer or bought some more feed, maybe paid down some expenses so their cash is down. Their position's still good, but it's hard to go back into that. Anyway, that's why we like to have even dates on that. All right. So part of the analysis of capital is determining if the customer's financial position has improved or deteriorated over time. Again, going over why we get those historical records. Whether considering past, present, or projected financial statements, we as lenders have to examine the value of those statements relative to your previous position. So again, we always have to look back and see how you are doing relative to your previous position. Now, liquidity is a repayment risk management tool for us as lenders. And current assets that can easily be converted into cash are important sources of reserves to ensure that loans are repaid on time. So several formulas may be used to describe your liquidity position. The most common that I'm going to mention is the working capital and the current ratio. And so let's go right here. So working capital is your current assets minus your current liabilities. When we're talking about current assets, those are assets that can be turned into cash within a year. Current liabilities, those are liabilities that are due within a year. And so current assets include things such as cash, feed or crop inventory, livestock to be sold, calves, lambs, coal cows. Generally, like I said, everything that can be sold within a year. That's your current assets. And so working capital is the amount in which your current assets exceed the current liabilities. And so we want to look at that to see your ability to pay down your short-term debts. If you're upside down in your working capital, that means you don't have the cash or the ability to pay down your current debts right at that time. And so the current ratio takes into account this working capital here, is current assets over current liabilities. So for example, a current ratio of 2 to 1, that means your assets are twice your liabilities, indicate that the value of your current assets, often largely composed of inventory held for sale, could decline by 50% before liabilities would exceed liquid assets. So if you've got a current ratio of 1 to 1, that means your current assets equal your liabilities, then that indicates some potential problems for your liquidity. That means your cash flow position is deteriorated and you've got some problems that need to be addressed. And so having a good working capital situation is definitely important. Okay, I've got a little example here. This is an actual snapshot of kind of a summary of a borrower that we've dealt with. If you look here, Let's have a look at his net worth position. So in 2011, $1.2 million. He's making progress, right? Doing very well. And we look up here at the working capital, the liquidity. His working capital is good. You look at the current ratio and it's gone up and down. It's gone up over 5,000% down to 275%. The percentage isn't so as much as important as you look relative to how much assets versus liabilities. If you look here too as well, talking about those even dates I talked about, these are the dates we got the balance sheet. So these two are very similar. In April, then we got one in February, then we got one in January. If you look right here, I had $80,000, which you might think might be a concern, but what happened there is they had was it some hay they hadn't sold yet or hadn't been paid for, so their operating line was drawn out at that point. And so they show a large amount of current liabilities there. But if you move back in here, then we got our next balance sheet in March. It's paid back down, and that's a good example right there of why we like to get the even balance sheets. But one thing I wanted you to look at here is everything looks good, and they're a good borrower. One thing that was of a little bit of concern right here, if you look at the total liabilities, their net worth was going up, their working capital was staying within a healthy range. But right here, what's happening? Their liabilities, they've added 100,000 there, about 200,000 there, and another 100,000 there. So they're getting pretty leveraged. They've still got a good debt to equity ratio. Anyway, I just wanted to use this as an example because you see it's a healthy borrower, but as their debt increases, that was a concern for us. As they're taking on more debt, they're healthy right now, but as that debt comes higher and prices drop, that debt capacity, their ability to pay that is going to diminish because as prices drop, their income also drops, and now they've got a lot more debt capacity moving into these lean years. All right, so solvency, the definition of solvency is the degree to which the current assets of an individual or entity exceed the current liabilities of that individual or entity. It can also be described as the ability of a corporation to meet its long-term fixed expenses and to accomplish the long-term expansion and growth. So it's one of the most important risk measurements as a lender that we look at is your solvency. There's 3 measures of solvency that document the relationship between total assets, total liabilities, and customers' owner equity. And so I'm just going to, again, briefly go through these. There's debt to equity ratio. This is your total liabilities over your owner's equity. And so your owner's equity, that's your assets minus the liabilities. So then we take your total liabilities over your owner equity. It's also known as your leverage ratio. How leveraged are you? So a debt to equity ratio of less than 1-to-1 means that the customer's owned capital exceeds the amount of debt capital in the business. So we want it below 1-to-1. A value greater than 1-to-1 means the creditors have a greater claim on the business than does the producer. So if your liabilities exceed your owner's equity, that means you're quite leveraged, and that there may be some concern there. Another ratio that we use is debt to asset, which is your total liabilities over your total assets. And also the owner equity ratio, which is basically the inverse of the debt to asset. So I'll just go over the debt to asset ratio. A ratio over 50% also means that creditors have a greater claim on the business than does the producer. Consequently, as the leverage ratio or debt to asset ratio increases, your solvency decreases. And so that's and the owner's equity ratio is just the opposite of that. As the ratio well, yeah, I'll just read that. As an owner's equity ratio greater than 50% means the producer, rather than creditor, owns a bigger share of the business. The next C is conditions. All right, conditions, These refer to the terms and conditions under which the loan is being approved. This is what we as lenders put on the loan. After we've analyzed some things, we need to maybe put some conditions on the loan moving forward. And so we have direct control over these, such as the loan amount, the use of funds, and loan terms. Again, the lender is responsible to make the amount and the purpose of the loan constructive and establish repayment terms that are practical for all parties involved. We don't want to just make it practical for us, but for you as well, and vice versa. So examples of some conditions on a loan might mean maintaining a debt-to-equity ratio of 65%, maybe achieve a working capital of $150,000. Oh goodness, I can speed up here. Or maybe maintain a base herd of 250 cows. Those are examples of conditions on a loan. Okay. The primary purpose of a loan is to improve the income and financial position of you as an applicant. And so conditions need to support our recommendation for the loan after the analysis of all the other credit factors. And so if we can see that you're taking on a large amount of debt, maybe one of the conditions again might mean to maintain a low debt to equity position. So that keeps you in a safe position. One of your conditions of your loan would not be to take on more debt. So what that does is that prohibits you from going out and getting more financing. Maybe there's a temptation to go out and buy some more. What that does is that will limit you in that sense, so that will keep you in a safer position, and it protects both you and the bank. Real briefly here, the amount must be adequate to serve the applicant's needs, yet be reasonable to supporting the management skills, repayment performance, and responsibility, and the collateral. The loan term, another condition, shouldn't generally exceed the economic life of the project or asset being financed. So what that means is we won't give you a 30-year loan on cattle because cows don't live for 30 years. So generally that's why you get the term loans on cattle can go up to 7 years. That's generally the life of a cow. Even though you're going to be cycling them through, that's generally how that works. That's why in real estate you can get 20, 30-year loans. And so we look at the collateral based on that condition. So, all right. The approval requirements and structure, the loan agreements, personal liability, additional collateral, margin considerations, and insurance should assure adequate repayment performance and collateral safety without disrupting the normal operations of the applicant's business. So we don't want to put a condition on there that's going to require a lot of effort a lot of stress on you. Say we're not going to want you to get us a new inspection of your cows every month because that's going to waste time. Maybe we'll get a yearly inspection, update your numbers. But we're not going to, we don't want to put conditions on you that are going to waste more time than help. So considering conditions, we need to look at necessities versus needs versus wants. I'll just put all these up here. We know what necessities are. These are what the operation has to have before credit's extended. You've got to meet the financial requirements. You've got to have farming experience. The needs would be, maybe a good example of a need is a repair, drilling a new well, etc. Wants, those might be the new vehicles or things that usually farmers get after they sell the farm. So that's usually how it works, right? So we need to consider all of those conditions, whether they're essential needs or wants. All right, let's get to the last one, is collateral. So collateral is an asset that is being pledged to the lender to ensure performance of the lending agreement. In some lending relationships, the collateral is the primary source of repayment for the loan. While other lending relationships, the collateral is the last line of defense for the lender to avoid taking a loss. So here's an example, a feeder operation. The collateral there is going to be the feeder cattle themselves, but they're also going to sell those off. That's their repayment capacity as well. Whereas a real estate loan, we're taking that more as a line of defense. If the loan were to go bad, then the bank would sell the real estate to pay the loan down. And so there's all sorts of different types of collateral. You got personal property, which is typically described as any tangible, movable, or immovable property other than real estate, your cattle, your crop inventory, equipment. This form of collateral is normally used in short-term financing. So your cattle loans, your equipment loans, those are generally 3 to 7 years, 3 to 10 years. Real estate, physical land and appurtenances affixed to the land, for example, structures. This form of collateral is generally associated with long-term financing, like we mentioned earlier. But it can also be used for short-term. And a lot of people put up real estate for short-term loans, operating loans, and that's fine. You can generally get even longer terms on a short-term loan. So, real property, this is associated with real estate. This is interest, benefits, rights inherent to the ownership of the physical real estate. So, for example, mineral rights, timber, other rights and interests that come along with that property. Okay. We already talked about this. The short-term loans are usually secured with the personal property, but can also be secured with real estate. As the loan term increases, generally the need for security also increases. So we have a loan to value, and I think that'll be talked about here later. That's why we say we have a loan to value of 65%. So if your property is worth $100,000, we can lend you $65,000 on that, if that makes sense. So we have to maintain that loan to value. So if you want your loan to increase over $65,000, then we'll need to take more security. And so that's what a loan to value is, and if that makes sense. On long-term loans, primary security must consist of a first lien or an equivalent interest in real estate. We won't take a second position in real estate. That's just if you're putting up real estate for collateral, Western Ag will be in first position. I know I had to breeze through that last part, but are there any questions on that? On any of those 5 C's? Okay, thank you.